Toll Brothers, America's premier luxury homebuilder. Overall verdict, yellow. Watch. Toll Brothers was founded in 1967 in suburban Philadelphia. Today it operates across 24 states, building luxury move-up homes, active adult communities, and resort-style condominiums. Average selling price, just over $1 million. That is 2 to 3 times the US median new home price. The company is vertically integrated. In-house architectural design studios. TBI mortgage for captive origination. Title services. Construction management. They control the entire chain from land to closing. CEO transition. Douglas Yearley, who ran the company for 14 years, handed over to Carl Mistry in October 2024. Yearley's tenure was defined by margin expansion and aggressive buybacks. Mistry's first full year, fiscal 2025, showed the first margin compression in 5 years. That is the central question for TOL investors right now. Price versus intrinsic value. Current price, $155.67. DCF base case, $155 per share. You are paying exactly what the model says it is worth. Free cash flow of $1.03 billion against enterprise value of $16 billion. Cash return 6.4%. The 10-year Treasury yields 4.3%. Toll Brothers pays a 2.1 percentage point premium over the risk-free rate. For a narrow moat cyclical, 2 points is the minimum acceptable hurdle. TOL barely clears it, and with no margin of safety. The bull case at 9.5% discount and 7% FCF growth, $213. The bear case at 11.5% discount and 3% growth, $117. Entry with 20% margin of safety, $124. Current price is 25% above that threshold. Excellent business, fair price, not a screaming buy. 4 numbers define Toll Brothers. ROIC, 11.3% in fiscal 2025. That is the first time ROIC has been consistently above 10% across multiple years. Revenue compound annual growth rate, 7.3% over 7 years. Net margin, 12.3%. Expanded from 8.2% in 2019. Free cash flow, $1.03 billion in fiscal 2025. And shares outstanding cut by 36% in 7 years. That combination, improving margins, rising ROIC and shrinking share count, is how EPS grew at 19% annually, while revenue grew at 7%. The quality of that EPS growth is real. Phase 1 forensic screen, 1 signal triggered out of 8. Revenue, net income, and margins all growing in lockstep. Free cash flow positive in all 7 years. CapEx well below D&A, asset-light model on fixed assets confirmed. Days sales outstanding, 12 days in 2019, 5 days today. Toll collects cash at closing, near zero receivables. The one yellow flag. OCF divided by NI fell to 0.64 in fiscal 2024. Below the 0.7 threshold, but explained by homebuilder inventory dynamics. When Toll builds up land and WIP inventory, cash is consumed. In 2020 and 2021, when backlog was delivered, OCF jumped to 2.26 and 1.56. Same cycle, different direction, not a quality issue. Forensics passe. Phase 2 financial analysis. Revenue, $7.2 billion in fiscal 2019, 10.97 in 2025. 7.3% compounded annually. Deliveries grew from 7,900 to 10,000 homes. Average selling price rose from $850,000 to $1.05 million. Both volume and price contributed. This is real demand, not price inflation alone. Gross margin, 19.6% in 2019, peaked at 27.9% in 2024, then retreated to 26% in 2025. That 2.9-point compression is Carl Mistrai's first challenge. Operating and net margins followed gross margin through the cycle. Net margin, 8.2 in 2019, peaked at 14.5 in 2024, compressed to 12.3 in 2025. The expansion was driven by pricing power above construction cost inflation. The 2025 reversal, land costs and subcontractor prices in the backlog, ran ahead of what buyers would pay. Watch fiscal 2026 gross margin. Above 27%, expansion story continues. Below 24, the decade of improvement is over. DuPont decomposition, ROE from 11.6 to 20.5%. Net margin contributed plus 6.3 points. Asset turnover contributed plus 0.14. Financial leverage, minus 0.37. ROE improved while leverage went down. That is the highest quality DuPont pattern, better operations, not more debt. The 2025 ROE retreat from 20.5 to 16.3 is fully explained by net margin compression. Turnover and leverage held flat. Margin problem, not a structural deterioration. Phase 3 moat assessment, 8 of 9 filters pass. Verdict narrow moat. 2 confirmed competitive advantages. First, brand, 10 to 20% price premium over production builders. In overlapping markets, 55 years of luxury homebuilding hysteresis. Second, cornered resource. Entitled land in New Jersey, Pennsylvania, New York, and Maryland. Accumulated over 2 to 3 decades of local regulatory relationships. You cannot replicate that in a few years. What prevents a wide moat? ROIC cycles below 10% in downturns. No switching costs, no network effects. Brand premium narrows in Sun Belt expansion markets. Narrow moat, real, durable, not bulletproof. Phase 4 capital allocation. Verdict pass, a textbook Thorndike outsider framework. Share count down 36% in 7 years. The largest buyback years. Fiscal 2020 at P/E12, fiscal 2022 at P/E3.9. Management bought most aggressively when the market was most panicked. Simultaneously, $1 billion of long-term debt was paid down. D over E went from 0.77 to 0.35. 64% of free cash flow returned to shareholders. No dilutive acquisitions, no empire building. One open question: can Carl Mistrai sustain this framework? 1 year of data is too early to judge. Phase 5 competitive dynamics. Toll Brothers is in the stability stage. Powers established in the takeoff era, brand and cornered resource. Brand 10 to 20% premium, 55 years of hysteresis. Land positions, decades of local regulatory work in supply-constrained markets. Scale, procurement advantage versus regional builders, partial. No network effects, no switching costs, no counter-positioning threat. The competitive risk is not displacement, it is macro demand compression. At $1 million average selling price with 7% mortgage rates, the addressable buyer pool is the top 5% of U.S. households. Sustained high rates compress demand. Overall verdict, yellow. Watch. Toll Brothers is an excellent business at a fair price. Revenue grew 52%, net margin from 8 to 12%. ROIC from 4.5 to 14.2. 36% of shares retired, $1 billion of debt paid down. The moat is real, the capital allocation has been exceptional. But at 155, you are paying exactly DCF base case. A cyclical narrow moat business warrants 20% discount. That implies entry at 124. Watch the fiscal 2026 gross margin. That number will tell you whether this is a pause or a reversal. Buy below 130. The 10-minute quality test, 9 filters. 1 listed profitable positive OCF, pass. 2 ROE above 10%, 6 of 7 years, only 2020 at 9.2. Pass. 3 EPS trend, 407 to 1360, growing with 1 cyclical dip. Pass. 4 balance sheet, D over E 0.35, 8 years of deleveraging. Pass. 5 free cash flow, positive all 7 years, range 350 million to 1.24 billion. Pass. 6 no restructuring charges in 7 years. Pass. 7 share count down 36%. Pass. 8 of 9 pass. 1 yellow on ROIC, only 4 of 7 years above 10%. Toll Brothers qualifies. Share count, 146.5 million in fiscal 2019, 93.5 today. Minus 36% in 7 years. Largest buyback year. Fiscal 2020, 630 million at COVID-depressed prices. Fiscal 2022, 540 at P/E 3.9. The timing was exceptional, management bought when the market panicked. 7-year free cash flow, 6.57 billion total. Buybacks 3.62 billion, 55% of FCF. Add dividends, 4.2 billion returned, 64% of FCF. Remaining 36%, 1 billion debt paydown plus working capital. No empire building, consistent return at depressed valuations. Long-term debt, 3.92 billion in 2019, 2.92 today. D over E cut in half while buying back 3.6 billion in stock. Toll Brothers now holds the most conservative balance sheet among major homebuilders. A clean balance sheet is a competitive weapon in a cyclical industry. You can buy land at distressed prices when peers are defending their covenants. Note, TIE not meaningful for homebuilders. Interest is capitalized into inventory per GARP. 3 valuation methods. Cash return, 6.4% versus 4.3 Treasury. Passes but barely. P/E 11.4. High end of the 9 to 12 historical range. P/S 1.33. Above the 0.86 historical average. DCF base case. 5% FCF growth, 10.5 discount, implies 155 per share. Bull case 9.5 discount, 213. Bear case 11.5, 117. MOS entry at 20% discount, 124. Fairly valued, buy below 130.